Sam Stovall, CFRA's chief investment strategist. He's here now with more on the market action. He says the fallout from SVB's failure could keep the Fed on a 25 basis point hiking path. Sam, so that's where you come down. Not that the Fed's hand has been stayed for now, but that they will move in what many would consider a smaller increment than had been considered possible a week, 10 days ago.
Hey, Tyler. Yeah, I think that's likely to be the case, that we'll probably end up seeing the Fed hike possibly through the second quarter of this year, but then pause. And what they're not going to do is try to upset the apple cart any further by increasing the rate hike at the March 21-22 meeting, keep a steady path. So they'll probably have to change their mantra from higher for longer to just high for long.
So how does the market digest ultimately what's been going on over this past weekend? We've seen a lot of carnage in regional bank stocks today. Even some of the big money center banks, the big New York banks as well, have been stumbling a little bit. There you see a lot of the regionals or super regionals. How does this play out in the market over the next 4 to 6 months?
Well, don't leave out the brokers either. So basically, everybody in the financial space has had some challenges as retail investors, institutional investors worry about what is likely to happen to their accounts, to these banks, and what kind of an impact it will have on the economy, et cetera. I think we've also seen some pressure on the smaller cap stocks because banks, these regional banks, might be more reluctant to lend to the lower quality, smaller companies out there. So that, in a sense, could accomplish what the Fed is attempting to do and slow the rate of growth for the economy, as well as slow the rate of inflation. So I think over the next couple of months, we're going to have to take a wait and see attitude. Our forecast was for a tale of two halves, where the first half of 2023 is much more challenging, highly volatile, et cetera. But then investors begin to look across the valley sometime in the second half and toward a more favorable 2024.
Meantime, as Kate Lataushi points out, the Fed just released an FAQ saying that they will release details on who taps this new lending facility 2 years from now. So that would be March 2025, Sam. We also have a Lloyd Blankfein tweet, former Goldman CEO, first one in about 6 months. He sees positives. He says anxiety and volatility are high, but sharply lower rates, Fed likely on hold, strong positives from markets. Do you agree, or do you think we're risking a rerun of 2008 here?
I don't think we're risking a rerun of 2008. A lot of people that are still in charge were there back then, and they know what they needed to do to right the ship. So I would tend to say that if there are any mistakes, there'll be new ones, not repeats of old ones. I also think that history can offer some guidance, because the Fed usually starts to lower interest rates about 9 months after the last rate hike. And while the S&P was up an average of 13%, financials led the way up an average of 22%. So usually the groups that get beaten up on the way down tend to be outperformers on the way back up.
All right, my friend. Thank you very much. Sam Stovall, we appreciate it.